Welcome back to the channel, everyone. So I wanted to show you this stock that I've been analysing recently, and it's a company called Fortinet. You may not have heard of this company before. It's not a huge business, although it's not small cap either. Their market cap is around 25 billion, but it has the potential to be a real long-term compounder in my opinion. And this is something I'll be doing more of going forward. Of course, still covering the type of companies we do at the moment, but also try and give you a look into some companies that are out of the spotlight that I'm analysing for a potential investment and have the potential to be high growth long-term compounders. So Fortinet, they are a cybersecurity software company that sells all kinds of products, protection products ranging from firewalls to antivirus and intrusion prevention. They were founded in 2000, so this is a company that has stood the test of time in many ways with the 21-year history to date. They are run by the two brothers who founded the company, which is always a massive bonus to have owner-operators at the helm of the business. These businesses, as we have covered already, are likely to perform better over the long term. These are the type of businesses that do not neglect short-term progress for long-term vision. And they're the type of companies that I want to be investing in. Look, they are a fairly complicated company in terms of the products that they offer, the range of products and what they actually do, how those products are better than the other products out there. So if you're someone who doesn't like to dig into all of that, it may not be one for you. However, the financials are very compelling. More importantly, though, what really put Fortinet on my radar? So in today's market, which is very frothy, don't get me wrong, there seems to be more businesses than ever that are good businesses, but the price to pay is also very high. So we're running dry on options. And one strategy I am employing to save me a bit of time is on a quarterly basis looking at what the investors who I follow and typically have an aligned investment strategy with are buying. And a lot of the time I pass on these opportunities, but sometimes you come across something that looks quite compelling. And in the case of Fortinet, I saw that Terry Smith had almost tripled his stake in Q4 2020, probably around the same price that it is today. Now you might ask, who is Terry Smith? Well, he's a fund manager in the UK, manages around $30 billion, so he's no joke. And most of the stocks he owns are US companies, and his track record very much speaks for itself, averaging 18.5% over the past decade and almost 20% over the past 5 years, especially considering he's having to manage such a large amount. He's pretty much wiped the floor with the majority of fund managers who are also only managing around a tenth of what he does, if that even. So just quickly, here is his investment strategy, which I like because it looks very simple, but it's actually hard to stick to in practice. High quality businesses that can sustain high returns on capital, businesses whose advantage are difficult to replicate, businesses who do not require significant leverage to generate returns, businesses with a high degree of certainty of growth from the reinvestment of their cash flows at high rates of return, businesses that are resilient to change, particularly technology innovation, and businesses whose valuations are considered by the company to be attractive, not just attractive on paper like a low PE or a high yield. You can see his return here from inception. This is post fees as well, so 18.2% versus equities in general at 11.9%. And you can see some of the top holdings here. I know we just looked at them, but you've got PayPal, Microsoft, Facebook, Estee Lauder, Intuit, L'Oreal. So some big companies. So Fortinet's not on there, but obviously with it only being a 25 billion market cap and him managing more than that in his fund, it's not going to be at the top. And to give you an idea of how much I do actually trust this investor, well, I put the majority of my mum's pension into this fund. So that should give you an idea of how much I am convinced by his performance. Okay, so let's jump into what Fortinet does. Now, I'm not an expert in this field, nor do I claim to be either. So I would suggest doing some research yourself if you are actually looking to invest in this company at the end of this video. But simplified, it is their aim is to deliver the most innovative, high-performing network security platform to secure and simplify customers' IT infrastructure. They provide an end-to-end integrated offering for cyber solutions whilst adopting AI and machine learning to predict patterns of cyber attack rather than just defense or prevention, which sort of sets them apart from the rest of the people in the market, is what I've got from it so far. The revenue streams are split, so you've got product revenue, which is physical product sales such as firewalls, etc., but they actually outsource the majority of the manufacturing for this, which is why they have such good margins still. Services or software as a services revenue, which is software solutions to cyber security and risk consulting or advice. Now, the reason why I like Fortinet, just a few points to go over. So it appeals to the mass market. The customers come in all sizes and different industries, government organizations, large corporations, SME businesses, healthcare businesses, technology businesses, and they have around 500,000 people using their products, which is a huge amount of customers. They're led by the billionaire founders who have a vision to be the best, and I always like to see a company that is still run by the founders. And the founders have been in this industry for over 21 years, been successful for 20 years. There's no reason why they should stop doing so now. They're best in class in their market in terms of profitability and growth, so touching on the financial side now, mainly due to the adoption of outsourcing for product manufacturing and focusing more on software as a service revenue. Their total addressable market is expanding, and there's still a small capture of that market. I think I saw that put here that their total addressable market currently is around 73 billion, growing to 93 billion by 2024. They seem so a growing total addressable market and a very small capture of that right now, which is a huge positive for me. The financials, which we'll get to in a second, are fantastic, and it has all the characteristics of a long-term compounder. A couple of things that aren't listed on here as well is that almost all of this company's growth has come from organic growth, not acquisitions. Every time they've had to innovate or adapt, they have done so organically, which is just a great characteristic to have. Also got their margins, which they actually talk about here. Margins have been, which we'll get to in a sec, have been improving very steadily over the past sort of 5 years, and it looks like they think this can go up even further, especially with the company becoming more of a software as a service company rather than physical products. Okay, so let's jump into Fortinet's financials, and this is what gives me the most excitement. As you can see, revenue growth has been amazing for the past sort of 5 to 6 years, averaged 22.5% over the period, and if we go back a decade or even further than this, the growth was around 30%. So it's dropped slightly, but as they've got bigger, it's obviously harder to maintain that 30% growth. But good to see that this year in 2020, they posted 20% growth still. Earnings and free cash flow have actually been growing at an even faster rate. So you can see earnings have grown at 71% over the 5-year period here. Margins, like I said, have been improving, and they've now got up to around 20% earnings margin as the business has started to mature. Free cash flow grown at 37% over the period. They've got a lot of non-cash items that appear on the income statement, which is why free cash flow and the margins are so much higher than EBITDA. But that's nothing to be too worried about. It's actually quite good to see sometimes, because it means the company can be being valued as its earnings, when actually a lot of the time we should be looking at free cash flow anyway. Shares outstanding. It was interesting to see this. They've actually bought back or retired a few shares over the course of the period. So it's gone from 178 to 168 over the course of 3 years. So they're actually buying back shares. This part was really interesting. Company had zero debt, no debt whatsoever over the course of its history from what I could find, which virtually means there's no risk. When a company has no debt, it's very hard for it to ever go bankrupt. So there's only really investment risk here, the investment risk of having a poor return, but we'll get into that in a moment. Cash, they've got a fair bit of cash on the balance sheet, so a very healthy company in that sense. Looks like cash has dropped this year, where they've obviously put some investment into the company. The shareholder equity dropped a little bit as well, which I haven't been able to look into why that is, but still a healthy amount of shareholder equity. The stock's performed well over the past 5 years with an IRR 43% over that period, which somewhat matches the cash flow and EBITDA growth or earnings growth, which is quite good to see. And if we just touch on that free cash flow yield that we looked at on the Facebook video as well, so a 3.5% free cash flow yield in today's world, where the 10-year treasury gives you around 1.8%, so a healthy yield, and that yield's likely to grow around 20% going into the future. PE and EV to EBITDA looks quite steep from those perspectives, but like I said, a lot of non-cash items that actually take off from the earnings, which makes the earnings seem lower than they actually are. Cash earnings or free cash flow that the company generates each year much higher. So that should say free cash flow margin. Sorry about that. So free cash flow margin of around 36%, which is really, really high. And I think this has obviously started to track upwards as they've become more of a service company rather than pure product revenue. So I've drawn up a forecast. Nothing special about it, just growing at 20%, which they have managed for the past decade, and then dropping to 15% from 2025 to 2030. Margins stay the same, although they are showing signs of improving. Shares outstanding reducing at 1% per year as they are already, and then cash just growing at around 10%. As I said, nothing special about the forecast, but just showing that if they can continue to do what they did for the past decade, then it will be a very good investment from here. And then for the terminal values, I've gone with a 25 times EBITDA multiple for the multiple method, and then a perpetual growth method, which just assumes 3.5% going into infinity, which is quite a drop from the 15% that we're going to see in 2030. But it still gives us a fairly large terminal value, around 117 billion. We average the two out, and that gives us an enterprise value of 99 billion in 2030, plus the cash, assuming no debt still. And then that's a market cap of 104 billion in 2030, or a share price target of $651 per share. If we discount that back at discount rate of 15%, and then get the intrinsic value of all of those future cash flows, we get a share price today, or a fair price today, of $207 per share, which means that Fortinet is 22% undervalued today, and we can buy with a 20% margin of safety. So based off those forecasts, I've actually shortened the IRR to a 5-year IRR, just to give you an idea of what sort of return you could get from Fortinet if those forecasts are correct, or maybe a little bit more bearish, or even better if you were to invest today and hold for 5 years. So off of the base case, which basically mirrors the first 5 years of our forecast that we just looked at there, showing us an IRR of 28%, and then a bearish case, which basically assumes that they only have 15% growth for the first 5 years, and then they're selling at a slightly lower PE of 20 times. That means that an IRR of 14% is most likely. And then in our best case, which doesn't seem out of scope, we have 25% growth instead of 20%, and then they're selling at a higher premium still, which is around a 30 times PE, and that assumes a 37% IRR. So even with the bearish case, that's a market-beating return, and overall the scope of possibilities or probabilities look very positive on this one. Okay, so in summary, looks like a good company, a leader in its field, best financials in its industry as well, has been growing at a very high rate for a long period of time, which looks like it is set to continue with all of the catalysts. We also have owner-operators at the helm who have a long-term vision for the company's future, which is good to see. Also have the benefit of knowing one of the world's best investors, at least in my opinion, is bullish on the stock's future at this current price. So wanted to just give you a look into one of the companies I'm analysing for a potential investment at the moment. I'll be looking into it a little bit more and let you know whether I proceed with investing. Hope you enjoyed it. If any of you have knowledge of Fortinet, I'd be glad to hear your thoughts in the comments below. We'll see you in the next video. Good luck with all your investments.